All right, let's jump right in. When most people look at a stock chart, what do they see? It's just chaos, right? A bunch of random squiggles going up and down. But what if I told you that to a professional, that's not noise at all? It's actually a language, a kind of secret code that tells them what a stock might do next way before it happens.
So, is that for real? Is there really a hidden language in these charts? Well, that's exactly what we're going to crack open in this explainer. We're going to pull back the curtain, step into their world, and see the market through the eyes of what they call smart money. We're going to find out how they read these secret patterns.
And this really shows you the night and day difference in how people see the market. On one hand, you've got most of us. We see noise, we get confused, maybe a little emotional, right? But on the other hand, the pros, they're looking for something totally different. They're searching for the quiet, almost invisible footprints of the big institutions, the smart money, as they slowly build up a massive position. See, they're not guessing, they're reading the clues.
Okay, so how in the world do they do that? Well, one of their absolute go-to tools is a pattern most people have never, ever heard of. It's called the VCP. And trust me, it's the master key to unlocking how smart money works its magic when nobody's watching. So, what is this VCP? It stands for Volume Contraction Pattern, and it's basically the fingerprint smart money leaves behind. Think about it like this. If a giant hedge fund wants to buy, say, 1 million shares of a stock, they can't just hit buy all at once, right? The price would explode. So what do? They're sneaky. They buy a chunk, let the price dip, buy some more, let it dip again. And here's the magic trick. With every little dip, the amount of selling, the volume just gets quieter and quieter and quieter.
It's a process, and it usually happens in about 4 stages. First, boom, you get a big, strong move up. Then comes the first cool down, the first contraction. After that, you get a few more pullbacks, but each one is smaller, tighter than the last. It's like a spring coiling up tighter and tighter. And what this is telling you is that the big players are just soaking up all the available shares. And then, once there are basically no sellers left, kaboom! You get that massive breakout to new highs.
But here's the thing. The price tightening, that's only half the story. The real secret, the piece of the puzzle that makes this whole thing tick, it's the volume. Volume tells you the truth that the price tries to hide.
Yeah, there's a saying among the pros, and it is golden. The volume pattern is more important than the price pattern. Why? Because price can lie. It can be faked. But volume is the truth serum. It shows you if there's real conviction behind a move. It tells you if the big boys are actually buying or if they're just dumping their shares on unsuspecting retail traders.
And that's why spotting the difference is everything. A real, genuine VCP, the volume just vanishes on the pullbacks. It's like the market goes silent. That's your sign that the sellers are gone. But a fake-out pattern, you'll see the exact opposite. You'll see these big, ugly spikes of selling volume every time the price dips. That's a massive red flag screaming at you that institutions are selling, not buying.
And hey, if you don't believe me, just look at the data. It's brutal. A breakout that happens on huge volume, yeah, that's got about a 75% chance of working out. But a breakout on weak, pathetic-looking volume, it fails 80% of the time. Think about that. It's the classic sucker's play. The price pops, everyone gets excited and jumps in, and then the floor falls out. Seriously, ignoring volume is probably the single most expensive mistake you can make.
So this is why understanding volume is like a professional's armor. It's their shield. It lets them see through all the noise and tell the difference between a golden opportunity and a trap designed to fleece retail traders.
I mean, look at this. It really lays out the 2 different playbooks. The pros, they're like detectives, patiently looking for these tiny clues inside the VCP. They get in when everything looks boring and quiet. And the average retail trader, well, they tend to do the opposite. They chase the stock after the big fireworks show has already started, totally ignoring the volume, and then just cross their fingers and hope when it starts to go against them.
And the results? Well, the scoreboard doesn't lie. Look at this performance gap. It's huge. A pro who knows how to read volume in a VCP is successful 75–80% of the time. The retail trader who doesn't? We're talking 30–40%. It's not even close. And look at avoiding failures. The pros are almost at 90%. The edge you get from this is it's absolutely massive.
So what's the big takeaway here? What are we supposed to do with all this? It's that being a pro isn't about memorizing 50 different chart patterns from some dusty old book. No, it's about a complete change in how you think. It's about becoming a pattern detective. And that mindset really boils down to 4 key things. Number 1, contrarian patience. You learn to buy when things are quiet and boring, not when they're exciting. Number 2, volume detective work. You spend way more time looking at volume than at price. Number 3, quality over quantity. You wait for that single perfect A+ setup instead of chasing 10 mediocre ones. And finally, number 4, ruthless discipline. You get out at the first sign of trouble, protecting your cash, instead of waiting for the disaster to be confirmed.
So from now on, when you look at a chart, don't just see a squiggly line. Look deeper. Look at the volume. Watch for those quiet contractions. Because you now have the key to the decoder. You know the language. So the only real question is, what stories are the charts going to tell you?